Hi, everyone. Welcome to the TimingResearch.com crowd forecast news. This is a special Labor Day edition, pre-recorded for September 2nd, 2024. And this is episode number 445. My name is David Cosbetter, and I am the creator of TimingResearch.com. And just a quick announcement, we will be having a special Fibonacci and Elliott Wave trading strategies event on September 10th, 11th, and 12th. We're going to do a full 10 hours of education all 3 days. So again, just join us at TimingResearch.com on September 10th, 11th, and 12th for that event. And now today, I have a special market outlook update from the option professor, and I'm going to go ahead and turn it over to him.
Okay, thank you, David, and welcome everybody. We are going to go over a number of things here today. A quick introduction by myself. I'm Jim, the option professor. I have been educating people in the option area for decades, and used to do live seminars throughout the country and into Canada. And now, of course, we do the webinars. Basically, I was trained at the Options Institute in Chicago, as well as some of the major firms in the country. And so I've been involved with the product of options for a long time, and I'm very knowledgeable in the subject. What I'm going to try to do is obviously share that information with you. Today, I'll be sharing with you my opinions and my views, but there'll be no advice. Obviously, that is for your broker to decide as far as your suitability and the ideas you decide to go with. But I will be sharing my views and my opinions, okay? All right, so let's get started. And again, with regards to the markets here, we're going to start out here by looking at the S&P as of Friday afternoon. And basically, the market did open a bit higher. Let me put the one-day chart up there. You get an idea. And then, of course, it started to roll over. Now, again, what I believe is probably causing the rollover today is the PCE report came out, and it showed it was in line with what the Fed was looking for, or the markets were looking for, but it's certainly not, collapsing down to 2% like they were hoping. And as far as spending is concerned, and wages are concerned, they're still rising. And particularly in the service section, I think it was up 3.7%, and food and energy were also up as well. My take on this is, with the unemployment rate in the 4% area, and with the inflation rate at least 50 to 75% higher than what their hope is, I think it's very difficult to build a big case for all these cuts they're talking about, unless something comes out of left fields and really whacks the markets and whacks the consumer. Because again, the consumer is still out there spending. You saw retail sales numbers, and you've seen now the PCE report, all underscoring the fact that the consumer is certainly not dead at all. With regards to some of the areas where this consumer has been a little bit softer, like maybe on real estate sales, that may still have an awful lot to do with the fact that people have low mortgages. There's just not a ton of inventory out there, and that's going to skew that number, I think, for quite a long time until these people start unwinding their 3% mortgages and 2.7% mortgages, which is going to take a while. At any rate, let's take a look at what's going on. Again, I'm a big believer in trend, and I'm a big believer in momentum, and I'm a big believer in reversion to the mean. So I'm going to go over the markets a little bit here, and then I'm going to review some of the ideas that the option professor options alerts talked about in the month of August. We are very excited. We had some very big movers in August, and I'm going to review some of them here a little later. Then, of course, I'll give you what I think is going to happen as well. So here you go. We are in a situation where the market clearly is near a double topping area. So the high up here was 56. This is on SPX. That's the cash market, right? That was at 56.70. And then we've made some attempts to go up there again this week. And as you can see, it has gone up near that area, but certainly has not exceeded it. In fact, I think we're about 20 points under yesterday. And now, of course, it has rolled back over again. Now, my red line is very important. It's still rising, so you can't get negative when the thing is still rising. If you notice, if there's going to be any substantial drop, the red line's got to be pointing down, and that's just not happening yet. So that's why It's a little too early to bring out the bear costumes. But where is that line? It comes in at 55.84. And so far today, the low has been 55.83. Probably not coincidental, right? So that would be a number you'd want to hold on to if you're bullish, 55.84. It so far has done that. And then we'll see how they take it home. Again, if you are going to revert to the mean, the blue line is down here at 54.95, and my green is at 54.70. So that would be a logical place if there was a reversion to possibly get some support. A full-on reversion would take you back down to 5,300. The RSI up here, can you see it's not exactly the most favorable because you are looking at a high on the RSI of 81, and then you got another high here, and the market made a new high, but RSI didn't. That's at 61, and then you got the big dump down here during that Japanese unwind trade, plus the recession scare that happened when you looked at the unemployment report last time. So now you've had a rally back up, but that's a pretty weak RSI. Still above 50. Okay, so that's not bad. And these numbers, like on the red line, is still pointing up. Not bad. But if you were to break under 55.84 and then break under 5,500, 54.75, and get the red line pointing down like it did over here in July, then that, of course, would open the door for a more significant drop, either down towards the blue line or maybe even a total retest. Case right this second, so it's a little early, premature to do that. Sometimes I will look at my longer term charts to get a bigger perspective. So again, you see this is 66 and 75 on our side on the 20-year, and way up here we're in a little bit lower than that RSI. So, and this is a reversion back towards 5,000 that it tried to do. So I don't know if there's going to be a more significant reversion in the month of September or October, which are historically dangerous months, but we'll have to see. On the 5-year graph, again, you got that double high point here. RSI up here, where were we? We are at 77, and now over here we're at 65. So, that's the thing that's the warning flag for me. That's the warning flag. Now, the flag of turning down again, 55.84 and 54.75. Those would be more confirming numbers. And where's the red line here at 54.97? So you can see there's a lot of action. When I call a lot of action, I call it a traffic jam. You got a traffic jam happening around 54.75, 5,500. So again, that's 90 points away from where I'm talking right now. So if in fact it goes down to that neighborhood, there should be some good support, right? But if it does break, you can't have a faraway look at your eye. You have to make your adjustments, I think. Now, again, this is a total uptrend since last October, right? You see the October lows, and this is a total uptrend. You had a reversion here back in the first quarter. You had a reversion here during that little, flashed drop here we've had recently. Notice it hit the line perfectly, so it's a great time to buy right there. And now you're back up here in the high zone without the relative strength really giving you much help. So again, if we break through the highs, you're home free, right? And that's 56.70. Okay. But if you cannot and you start taking out these other numbers, it's going to open the door for possibly a further reversion, maybe even a retest down here at 5,200 area. So again, you have to be flexible because again, we have had a very large run. I mean, let's be frank here. This thing has gone from 3,500 up to 5,700, right? In a year, right? So that's a big move, big move. And again, the interest rate picture, is supposed to change starting on September 18th. By the way, let's look forward here. What's coming up on the next Friday or this Friday coming up when you hear this will be the jobs report. We also have the JOLTS report. That JOLTS used to be 2 jobs for every 1 guy looking. It's now down to 1 to 1. So obviously that's really the air's come out of that one for sure. And then of course the claims are still good. I mean, as far as being a strong labor market, it's not a weak labor market. Those claims are firm. Spending is firm. So, this idea that they're going to cut all these times into that type of action, seems unrealistic. Now, if that all those numbers change and you start seeing a high 4 or 5 print on the unemployment rate, and you started seeing consumer spending rolling over onto retail sales or something, then you could get a little bit more where these cuts might make sense. And the only other reason it makes sense is the difference between the Fed funds rate and the interest rates. Let me just put that up there real quick so you get that idea. People think the bond market might have a big rally when they start cutting, but this a long term, this 10-year yield has come from 5% all the way down into the threes. So, Fed funds is in the fives. So, dropping a quarter will still put Fed funds, and the 2-year note, which is more linked to the Fed funds, is still in like 3.80, 90. So that's still well under 5.30. So they got room to cut simply to bring them more in line with market rates. But as far as cutting because the economy's weak, come on, GDP, they just hiked to 3% for the Q2. That's not weak. And then, of course, these consumers are still out there spending money and their wages are going up. So I don't see the backdrop where everybody folds their tent and goes home. At least I don't see it yet. And I see all of these people running into the bond market thinking rates are going to collapse as a panic almost, or maybe a desperation. Because one of the problems with the stock market is the valuation, right? The CAPE ratio is at like this very high level, which is inflation adjusted PE. And so, and then of course the relationship between the S&P and the small caps is the widest since 2001. And after 2001, of course, it wasn't the best time for the big caps. It was a good time for small caps. Let me throw that up there for you so you can see. Um, IWM is obviously the game in town for the small caps. And you can see here on that, this trend has turned up. But see, that's the all-time high on small caps at 240 and change. We're still in the 220s here, 218, whatever we are. And so there's a lot of real estate just to get to a new high. And so basically, this is why people think this is the place to be looking forward, because if they do drop rates, these people borrow money. A lot of these companies aren't even profitable. So it's very important for them to have lower rates. And so you can see this is where the real estate they're thinking is going to happen here. This is where the values make the most sense. Again, this is the best or the widest value differential between the Russell and the S&P since 2001, and the history afterwards was that the Russell outperformed the big caps for like 3 years in a row after that. So we'll have to see if there's a precursor on that going on. The other thing about the everyone wants the Fed to cut, the Fed to cut. Hey, listen, if you look at history, when the Fed cutting cycle starts, at best you go about a month of decent numbers, and then whatever reason they were cutting for starts materializing, and then the stocks have a difficult time, maybe for as much as a year later. So we're watching, I'm watching things very closely. You're not going to fight the tape. The tape has been very strong. You don't fight the tape. But if the tape does change and sustainably changes, not that 1 day deal on August 5th, but a sustainable change, I think you'd be silly not to make some adjustments in your portfolio on your asset allocation, type situation. So, basically that gives you a little bit of idea on why people think the small caps might be the way to go as far as at least getting diversified. QQQ, let's put that up there, and the SMH. Okay, so looking at it on a 5-year basis, again, it had a big reversion back to the mean. I mean, I'm big on that. I mean, when stuff is up here, you're not going to find me saying get in, get in, get in. I'm looking for the reversion back to the mean because that's really where the gains are coming from. After it reverts back, sure, then you take a bite at the apple, okay? But you do on a bull market, reversion is where you buy. Reversion is where you buy, not after it runs up. Then you get caught holding the bag, or you get caught in some conga line that's hope against hope that it goes back up. And that's not where you want to be. So again, this thing came down, rallied back up, did not take out the high here. So if it starts rolling over on QQQ, and of course the numbers there looks like 475 is kind of a big number. It looks like, yeah, see the blue line's pointing down. That's not a good thing. So 475 and then 460, 470. Yeah, 470, 475. And we're here right now. So again, with the blue line pointing down, you got to be careful that it's not going to, fall apart on you. RSI is hanging on for dear life right at 50. So there's going to be crunch time going into next Friday with that jobs report. You start breaking under 470, 475 on this thing, you start getting that RSI under 50, and this thing could lose some altitude because again, green is already under blue. Red got back above it, but again, the longer it stays under 475, it would turn that red line down as well. So again, very, very much a situation where this could be a pullback and it's going to roar next week. And the jobs report is going to be very supportive. And then you're going to fill that gap up here at 485. That's door number one. And then door number two would be you'd blow out the 470 number and you start going down to test the purple down here again. And the RSI breaks under 50 and starts looking more like it did a couple of weeks ago when we had that big drop. So be careful right here because it looks fairly binary to me. And so binary is always something to keep an eye on. And of course, when my moving averages join up together like this, it generally means something large is about to happen because when these things touch, yeah, that means the traffic jam is right here. And like any traffic jam, the bulls are either going to say you go first or the bears are, but it's probably not going to stay in a traffic jam that long, particularly with the month of September having what ahead of us, the jobs report and all the job stuff in the first week. Then you've got the debate with the president and Harris and Trump. Then you've got CPI on the 11th, so more inflation. And then you've got the 18th where they make their decision. If they come out and they do 50, maybe people get nervous that they're nervous, or if they do 25, maybe they think it's not enough. It could have an effect. Then you got the quarterly taxes coming out on September 16th. So the first couple of weeks could get pretty rocky in the stock market. So be careful of that, during the first couple of weeks. And then after that, we could see more of a clearing. We'll have to see. But again, these numbers are coming in very, very close here, as you can see. So we'll have to see. But, again, it's either a rally that's going to fail and we're back in the dumper, or it's a rally that's going to continue. And this is a pullback before a jobs report or something gets you to blow out this 485 number, fill the gap up at 495, and maybe even take out the highs. Okay, let's look at SMH. Okay, yeah, the semis, like I say, this is a traffic jam, and again, it'll be a binary outcome in my view. Okay, so where are these all coming in? They're all coming in around 245, right where we are now, 242, 245. Can you see that right there? Blue line pointing down is not a good thing. Okay, blue line pointing down because it's a longer term average. It doesn't turn around all the time, neither does green. So green and blue are telling you that we're going down. Red is trying to tell you it's going up, but you're going to need help, red. Red's going to need what? It's going to need 245 or better. It's going to need 250. And if it does, there's your gap to fill. 270 right there. So that's your target. So it's got 25 points in it if it gets moving, 25, 30 points in it if it gets moving. Again, if it breaks under here, here's another retest that could happen as well. So like I say, I'm expecting a binary outcome. Binary means it's either going to boom or bam, but it's not just going to stay in this little traffic jam, forever. On a 5-year, what's it look like? Again, couldn't get above the red line flattening out. That's not particularly positive. And where's the red line? 250. So you notice we went up towards 250, 253, couldn't stand the altitude. Now we're 242. On the 20-year, come down, hit that support. That's why when it went down here, this would be one of the reasons it would have been telling you take your bite of the apple when it went down to 200 and something, 205. So again, that gives you a little of the semiconductor thing. And why don't we throw up NVIDIA? They had earnings, this last week. And, my view on NVIDIA pretty much is clear as a bell. It's got resistance at 130, 140. That resistance is going to stay in effect until it gets taken out. And then, of course, it's got support down here at 90. Again, another reason why I like these indicators, because when it hits 90, you have a rising line, and that's where you take your bite at the apple. In fact, on my alerts, I discussed a bull call spread of 104, 114 after it hit there. And obviously, when it went to 130, the 114, the 104, 114 call spread, which went off at around $4, got to go to 10. So that was 100% more increase in the premium. That's the kind of stuff we kind of look for if we can find them. So again, that's where I like to do the action after the correction and after it holds. So that's why the 104, 114 call spread was a good idea. And of course, we got a nice bounce. Just a couple of other things real quick. How about super micro computer? Boy, that thing got nailed, huh? Well, it got nailed because they are questioning their accounting. And of course, anybody who's been around who hears that is going to be a little nervous. But supposedly these guys have got great sales growth, and there might be a deal where maybe they did some accounting where a sale should have been booked at a different time or something. If it's something like that, I don't think it'll be that egregious. If it's something more sinister, then of course there's more problem. But these guys do have quite a bit of business coming out of NVIDIA. And supposedly NVIDIA and Tesla might be redirecting some of their business to Dell. But again, the growth of their sales is certainly very, very impressive. And so again, this is why I go to my long-term graphs. It tells me where we should be looking. And so right down here, 330. And then on the 20-year graph, right there on the green line comes in at around 368, so 370. So 300 to 370, that might be an area to start taking a little look at it. That's why you look at the longer term graph sometimes. Okay. But yeah, so super microcomputer, again, it could be a buying opportunity down here for very, very aggressive investors. Okay. Now, I was going to we went over some of the different indexes here, and then I'm going to go over some of the bigger markets like the gold market. And let's see what's going on with gold. Again, it looks like they threw the dollar under the bus. I'll get to that in a minute. But you're looking at a situation here on gold, and you can take a look at the 20-year graph. This thing has been rising, pretty much along the way here. It had one break. You see, when the moving averages don't turn down and it breaks like this, you don't want to panic because, again, what did I tell you? When all the averages meet, something big's going to happen. And I would say going from 1800 to 2500 is something big happening, right? Okay. And again, when the averages are pointing up and they break it like this, to me, this is just they're trying to grab people's gold, and then they bring the trend right back up again. Notice how it tests here on reversion to the mean. So that's what I'd be nervous about up here, reversion to the mean, because it looks to me another binary deal. It's either going into a what they call a hyper stage, right? Where we can go to 27 or 2800 if they really drop the dollar down to 95 on the dollar index. Or you could be looking at a situation where it's going to have a reversion to the mean, which could take you as low as where? Under 2200 or even 2000. Okay. Nobody's looking for that. So that's what makes it interesting to me. On the 5-year here, you've got RSI at 80, then you got RSI at 72, and we're way up here and the RSI is at 72. So again, the RSI is in a region where it hasn't really blown out the 80 number. That's a bit of a divergence. And that certainly it looks like the poster child of a potential pullback. In the 5-year, 2400 could give you some support. And it should, because these are former highs. And then, of course, further declines would be to the other lines there. On the 1-year graph, again, let's take a look here. We got RSI at 80, and we got RSI at 68. Look at what happened. That's called a divergence, and bam, there you go. Run out of steam. You run out of steam, the engine can't go anymore. Here come the sellers. Up here, again, 65. Certainly another divergence from the 80. And there you go, reverting to the mean. And now we're back up here, and it's been just holding the red line beautiful, hasn't it? So basically, it's still pointing up. So that's why you can't get bearish, really. There's nothing there to hang your hat on if you're a bear. The RSI is right at 60, which is the key number, because if you go through 60, that's how you get to RSI 70 and 80. So this could accelerate to the upside. Again, binary, it looks to me. And again, up here, all your RSIs are right in that 60 area. So can you see if we break through 25.50, you could have a big acceleration to the upside, but if you can't, then the reversion trade makes more sense. Okay, so that's basically the gold market. If you're in there already, maybe you hang out and look for that big blow off to the upside. If you're not in there already, then you probably want to be a little bit patient to see if this thing is going to be able to take out 25.50. Your number's right there, 25.50. And you want that RSI blowing through 60. If that's the case, then it opens the door for a pretty good size move. Again, is this an up flag coming with a down pole? We're going to see that sooner rather than later, probably. Again, this Fed meeting is probably going to be real key because it's going to really give people an idea. Are they going to throw the dollar under the bus and let the thing just drop to 95 on the dollar index? Let me show you that real quick. Is the US dollar index. We were told, everybody in my newsletter, that this 106 area was the high point, and you can see 106, okay, and then 107. This is the highs, okay? And since that time, the dollar has definitely lost value. So this was a very good observation on my part. And then now you're down into more of a supportive area around the 100 even area. And if they're not going to cut their interest rates 4 times by the end of the year, the dollar will probably pick up steam because everyone dumped the dollar thinking that they're going to let the interest rates go down dramatically and they're going to cut like crazy. But the consumer spending and the GDP and the retail sales and the wages don't add up to, cutting rates like a maniac. Okay, so there you go on the dollar index coming into some support. This is where the risk is. You see, down here, it could go down to the purple line here, and now you're close to 97. If they let it go all the way down to 90 over time, and that wouldn't shock you the way this thing is starting to look. If it did that, then you're going to be looking at a much more significant thing. The fact that blue is still rising, though, and red and green are above blue, I think is something. And then, getting back above this number here, that's 103. If we got above 103 and 105, then everybody who's been shorting the dollar is going to get whacked. Okay. And everybody's shorting the dollar looking for it to go down here or down there. That's because they're looking for the Fed to cut rates like a maniac. And they may not do that. And that could also hold this number down here. So again, this is not a time to be shorting the dollar against a support zone, possibly. Okay. And that certainly is a poster child for reversion to the mean possibility, right? And so basically, be a little bit careful of that. But if they do cut rates dramatically, and if the dollar does drop under 100, then the gold may very well fly. So that's pretty much the story there. Let's talk about the crude oil. And crude oil still has backwardation, I believe. Let me see here. We're going to show you what backwardation means. Hold on, please. And then I'm going to go into the stuff that I do. Okay, I got to go back here, put 24 in there. Here we go. Okay, here's what backwardation means. You see the front month is at 20, and obviously it's dumping here today pretty good. One of the reasons I'll show you in a minute, but let me show you backwardation first. You see it's 74.20 in the October, right? Well, let's go out to March of next year. Oh, hold on here. March of next year. So we're at 74, and you see this is at 70. Okay, when the front month is higher than the back months, meaning the October delivery is $4 or so higher than the March of next year, that's called backwardation. That means the supplies are relatively tight. Okay, and when supplies are relatively tight, you wouldn't call that a bearish situation. Okay, so I wanted to show you that first. Now let's talk about the actual price. All I'm trying to show you there is the supplies seem like they're relatively tight based on backwardation. Okay. So let's go back up to the front here and I'll show you what the story is, because my story on this has been pretty consistent. Okay. My view on it has been that this, you can see right now, you're in a tight zone. You see the bottom there, the gold line, right around 70, right? Where is it? Yeah, $70. You know you don't want this thing with a 6 handle, because if it gets a 6 handle on it, that means something's happened. And you see this big sideways action? If in fact, not unlike Intel, when it was just holding $30 a share, holding it, had a couple of pops, but it was $30 a share. Let me just show you some here so you get an idea of what I'm talking about, because we did very good with this Intel. Okay, you see Intel on the 1-year graph. You see how it's holding 30, holding 30, holding 30, had a pop, came down there, still trying to hold 30. When that gave out because it had a bad earnings report, look at that drop. Well, if we go back to crude oil, I'm just trying to say that I don't know if it's going to obviously be a twin here, but I think if this thing on crude were to break this 70 area, there's just a lot of stuff underneath that could be a problem. There you go. You see, if you were to break under 70, that could be a big problem. So we'll have to see exactly what happens. On the upside, I think it's just pretty clear as day. This thing has trouble at $75. It has trouble at $80. And it has trouble at 85. Actually, look at the numbers here. Yeah. You see 75, well, 75, 78. Let's actually throw 75 out the window. It's 80 and 85. If you can get above those 2 points, then you can get going. And here's why I'm concerned about that. This is the Goldman Sachs Commodity Index. And it is half of it is energy, and the other half is metals and agriculture. Okay. So this thing is holding on for dear life too. And it had a bunch of opportunities to break through 600 and failed to do it. And the numbers are starting to roll over. So if this thing breaks down, you're going to see oil breaking down. Gold will probably join in on the downside to have that reversion to the mean. So this would be very deflationary. Okay. And that's what it's looking like right now. Now, if the Fed comes in and does some kind of a printing thing, like they do sometimes, and they get this thing running and it never gets above 600, I think it'll go up towards 700, which mean oil would break above 80, 85, and you'd have some really exciting energy markets. And Lord knows where the gold would go on the upside. So I watch this very closely, and if I would suggest to you do the same. So that's basically the commodity sector from the standpoint of the energy, metals, and grains. There is one thing that I would keep an eye on if you want a one-stop shop on the metals and keep an eye on it. It's this XME, because this will give you the steel stocks like Nucor, give you some Freeport-McMoRan on the copper, throws in a little Newmont Mining on the gold. I think there's some silver in there too. So it's a one-stop shop. And this is a long-term chart on it. So the bottom line is this thing turned up at $30 back in 2021. And this thing has been rising very nicely, holding the blue line. So the blue line comes in here at around 52 buck, 54, 58. And if this thing were to break above 65, it would probably mean that obviously tangible assets and metals are very, very in demand. And again, they don't make any more copper mines, so there is limited supplies on some of this stuff. But this is the one I would keep an eye on if you wanted a one-stop shop on this thing, because if this thing got flying, it could be pretty exciting. So there you go on that. The other thing I've been telling people about is keep an eye on international. If they weaken our currency, it's going to make those overseas markets look pretty darn good. Emerging markets, take a look at some of these things, because again, over the next few years, just like the small caps, you could be in a situation where these things could fly. This is the emerging markets EEM. Can you see that this might be something to keep an eye on? If we break above yellow there, can you see there's a lot of real estate up here? That's why I'm mentioning it to you. How about Mexico? Again, down on support, used to be up here. If it holds its support, might be something to watch down here as far as some value. Okay. But obviously the emerging market is the one that looks better if it breaks through that number. The other one people like in Latin America is Brazil. Let's see if there's anything there to, again, this one's under pressure too. So again, maybe not the best ones. How about India? Looks like emerging markets in India might be the better ones to keep an eye on. I mean, that's been a pretty much of a trained seal all the way up, right? This thing turned up. See, holds the gold line. That's where you want to take your shot. Gets above blue, take a shot. Get above purple, take a shot. So all of this area in the 40s, really where you should have taken your shot. And then, of course, it's way up here now. Any kind of pullback here towards 52 would be important. And that's India. And India, obviously, is a growing situation. You can see that right there on your screen. And then you've got Europe. And Europe boils down to two things. You can see Europe is also looking like it might get going too. And again, it's not way above its highs like ours is. So that's why there's potential in Europe, because again, if their currency goes up against ours, people could do a carry trade over there where they borrow in Japan or whatever at the low rate, and maybe they buy the European stocks and do a carry trade there. You don't know. But clearly it looks like it's just beginning compared to where we were, because we're way above our 4,800 S&P. These guys are pretty much right there still. And that's Europe. If you want to go UK, here's how you go with the UK. That means England, Great Britain. Okay. Another pretty much similar to Europe, but again, they're not in the union. So that's why this is a different deal. And it's a little stronger because, obviously with just the one country to deal with, it's a little bit easier because they have just the one fiscal situation. With the European Union, they got 19 different countries going 19 different ways sometimes. Okay, and the ECB is supposed to be cutting rates to get that European thing going too. So Europe looked okay. Clearly, emerging markets could have big potential. And then, of course, India. Those would be the three leaders right now. And then, of course, China. Now, let me tell you, I looked at the 13F filings and I saw David Tepper of Appaloosa and this Michael Burry from Scion. Both had sizable positions in China. And so basically, a couple of ways to get on that bandwagon, you know. See, I mean, is this thing about ready to go? Well, obviously, these two very big traders have sizable positions, and I think others do as well. Alibaba, Baidu, JD, these kind of companies. Well, bottom line is if it gets going here, there could be quite a bit of a reversion to the mean. I mean, going from 26 up to 34 would be quite a move. And there you go. It looks like it's already trying to turn right here. So this is something that I've been suggesting people take a hard look at. And this is the large caps in China. If you want the sister one to go with, it's the K-Web, and that's your internet stocks. So let's take a look at that as well. Okay, you got a low here of what, 38, and then you got another low here of 35. So the RSIs are kind of basing out. Looks like large cap China looks definitely better than the internets. But if this thing got going, there's a reversion to the mean potential, right? And these are the internet stocks over there. So FXI for your large caps and KWeb for the other, if you want exposure to China. If you think things will get better over there, they've got problems. Their GDP, they're cutting down to like 4% and change. They've got I read 48 million unfinished homes. Their unemployment in their youth is quite high. So obviously they're not at the woods yet, but dropping our dollar and doing other things that might help them could get the thing going a little bit. So certainly it's worth to take a look on that. All right. So we went over international. We went over the dollar. We went over the gold and the oil. We went over semiconductors and tech, the small caps, and of course the S&P. Now we're going to go over some ideas that I work with Option Professor and Option Professor Alert Service. Okay. So again, Let's take a look here at some of the large movers in the month of August that we identified in the alerts. Starting out with JetBlue. Now, I'm working mostly with strangles with my ideas. That means calls and puts at the same time on the same stock. Okay. And a lot of I did was around earnings, looking for some explosive moves coming out of earnings. So here I'm just going to briefly go through a bunch of them here, so you get a flavor on what I'm looking for. You see, JetBlue came in here and basically was in a very tight window, and it was in what was around $5-6 before earnings, right? So we looked at the $6 call and the 550 put, and it was like 68 cents going through earnings. And so we thought that was pretty darn cheap. $68 for a call and a put with a 50-cent window. I mean, if this thing got news, it could be something big. Well, here's what you looked at. After they got earnings, the darn thing jumped almost to 740. So the $6 calls were $1.40 in the money. The combination of call and put only cost 68 cents. So going to, $1.40 or something obviously was a big move on the strangle. And then if you went out a little further in time than I did, you could have also caught the darn thing on the downside, because within a couple of weeks, it was already in the tanker again. So this is a deal where the strangle got action on both sides. Next one up was the regional bank. They had a big move early in the month, and I thought that there was going to be a reversion to the mean. So you see it's up here at 60, and look at all these gaps and stuff. So if I was thinking there was going to be a reversion to the mean in the stock market, which I did, I would also think that this might have potential to revert as well. So a 61 call and a 58 put bracketed it, and it was $175 for that strangle. When you go down to 52 or 51, that means your 58 put is $7 in the money, or $700. And if you're into the whole strangle for 175, that is a very large increase in the premiums. And that's what the strangle is supposed to try to achieve, is big volatility on one side or another. And of course, it goes right back up. So, I mean, if you want to continue trading the thing after it goes down and you see it hitting the blue line, you could take your calls down from 61 down to 54 and then catch it back on the upside if you wanted to trade it. But just the original idea of the strangle up here was a good one. Okay, next one up is Intel. Now, sometimes the strangle will be against what you in your gut think is a good idea. Here, we had Intel jump up to 30, 37 or so, right? And then it came back down here before earnings. And you would think it would hold the area of 30, right? And maybe go back to the purple line. It makes sense to take a $32 call for $125, including obviously you're trying to go through at least a couple of weeks to get through the earnings. And then you take a 28 put for $50 just as an insurance. And the next thing you know, you wake up and the thing goes to 19, and that put you thought was just in for an insurance deal goes from $50 to $900 because you get that kind of volatility. So that's an example of you thought it would do one thing, but it did the direct opposite. And that's why the strangle made some sense. Not only that, at $175, that's a pretty cheap deal. Next one up was Chevron. Okay, on Chevron, we were up in the 156. You see, remember I told you about a traffic jam? You get a traffic jam, it's not going to stay the same. It's going to have a pretty binary move in my view. Okay, not always, but in my opinion. So here we go with a 160 call, and this was before earnings. And then basically we went with the 149 put. So it's a pretty wide window. It cost about $295. But look what happened when the earnings came out. We dropped all the way down to 142. Actually, it all the way went to 140, but at 142, the put was worth $700, and we were into the combination of both in this idea for $295. So 295 to 700 intrinsic was not a bad volatility. Next one up was Apple. Now, months ago in June, Apple was trading at Alcoa, Apple. Okay, Apple was trading before their convention. You remember they had that worldwide developer convention? It was trading 185, 195. So this was not an alert, but this was something that I personally did. $200 call and a 190 put for about 340 bucks. Total risk. Obviously, these are all limited risk because you're buying a call, buying a put. You're not doing any, butterfly this, an iron condor that, or anything else. And you're just looking for volatility and you're trying to buy it before it hits. So in this case, obviously, after they came out of that convention, look at the action. And the call option at 200 just went crazy on the upside. Again, we're over here before earnings. And so I thought, again, it's not going to stay in a traffic jam here. It's going to make a move. And of course, this August 5th, when it got extremely volatile and the VIX jumped to 65, was very helpful for all of these ideas we're mentioning. So basically, you got a situation where the 227.5 call and the 207.50 put for $4. When we go down here to 195, the puts go to like 1,200 bucks. So, and then of course it goes right back up. So again, there was also a trading opportunity here as well. Next one up is Shopify. As you can see, we're not in one sector. I'm looking around to all sectors to find out where I can find what I believe to be a good favorable setup, which is that the premiums are very reasonable. There is some news coming down the pike that should move the stock. The amount of time we're picking up should be ample. There's many factors that have to coincide here, and that's why it takes a long time to go through everything to try to find them. We did find one here. So here on Shopify, it was a 62.49 strangle for about 275 bucks. It then went all the way up to, you can see on August 15th, we went up to 75 bucks. And of course, that would make the 62 call go into the money by, well, by what, 1300. So 275 to 1300, that's a very volatile move. But again, the reason we were thinking that it was before the earnings and it was right around this congestion area and it was coming out of this very low area. So this is a reversion to the mean and then some. So that was obviously a very exciting one to strangle. Cloudflare. You've seen Fortinet going crazy. And again, I'll get to Zscaler in a minute, but the sector was getting a lot of money thrown at it because of the breach down at CrowdStrike. These other companies got a life to them. So again, in here, we were in this congested area around 76 or 7. So a 79 call and a 73 put for 270 bucks and change looked like it made some sense. When it went up to 85, obviously the 85 minus 79 call meant that it was intrinsic 600. Wasn't a barn burner, but it wasn't bad. The one that was the barn burner was the Zscaler. Again, I was noticing that money was coming into this sector, and this thing was down here, and then it got above my red line here. So when it got above 170, the 182.50 calls against the 155 puts for 379. When we jump up to 202, they go 20 bucks in the money. That's $2,000, and the maximum risk on it was 379. So again, caught some pretty good volatility because we noticed a sector getting cash thrown at it again because of the breach. Now, many other factors, but that was obviously one of them. And then Cardinal Healthcare. These all happened in August. Okay, Cardinal Healthcare, again, it's another one has earnings coming out. Okay, so the 102.93 strangle for 280 bucks when the price of the stock was down here just turning up at around 100 or whatever, right around there, was not a bad idea. And obviously this thing has kept going and going and going, but it went to 100 and it went to 110. 110 minus your 102. That means the 280 went to 800. Nothing wrong with that. And of course, like I say, it has kept going. It has kept going. Next one up in these last two are very recent. Um, this is Affirm, AFRM. Now, I looked at, well, I'm going to show you what I looked at first, and then I'll show you Affirm. I looked at this company. These guys are into the lending thing too. This is called Upstart. And so I noticed that Upstart had some earnings, and look what Upstart did, right? So I'm just like on, when I saw Fortinet going crazy, I figured jump on Zscaler. And when I see Upstart going here, I say, this firm's got earnings coming out last week, and basically I thought that they might run. So when it was down here in this range, it was turning up, right? And it was underneath here. So when when it was at $28 or something like that. Actually, it was even lower. I think it was like 26, 27 bucks. The 2750 calls and the 2250s were going for 377. Might have been at 28. Might have been in the money. Anyway, 377 bucks for that strangle. And then of course, when you go to 4250, and it's actually above that now, but at 4250, that call was in the money by 1500 bucks. So 377 to 1500. Again, that's why you try to buy strangles before news sometimes. It don't always happen, but when it does happen, it can be a very good thing. So that was Zscaler, and these don't expire until September 20. Um, with regards to Affirm, that doesn't expire to September 20, and Zscaler doesn't expire till September 20, and the last one here is Best Buy, BBY. Again, they had earnings, and obviously they knocked the cover off the ball. And when they knock the cover off the ball, people are not ready for it, and that's what happens. Everybody wants in, and the market maker pumps up the price. So we looked at it before it moved because it had earnings, and we did our idea was 92 call, 83 put for 460 bucks. This thing popped up to way over 102, and of course that makes it a $10 deal, which would be $1,000 or more, actually more like 1,100 on a $460 deal. So this was another one that popped pretty good. So again, that's kind of what we're trying to do with the options alerts, is to try to find companies that have reasonably priced options. Their technicals look like they are building some kind of steam in one direction or another, and they got something that could come out and stimulate the price. It may be a convention like Apple. It could be like in June's Apple. It could be a new situation, like the cybersecurity breach from CrowdStrike gets people to put money into the other cyber companies, thinking they may draw business away, whatever their reasoning. Or it could be a retail company that obviously, if they come out and they tell you their sales are going crazy on the upside, and why wouldn't they be? Retail sales are up. What do you call it? The consumer is out there spending. Their wages are rising and they're employed. That builds a reasonable story that Best Buy could go up. So it wasn't an unreasonable thing to take a chance on it. So basically, that's what we're trying to do here. And I'm just going to sign off here by giving you and extending you a special offer. And here it is. The website to go to for this is very simple. It's optionprofessor.com/option alerts. So that's option, OPTION, singular, professor, PROFESSOR.com/alert. Option alerts, OPTION alerts. And that'll bring you to a landing page where you can get into this thing with regards to the option alerts. Now, here's what you get. Okay, first of all, we want you to know what you're doing in options. So we've got an options master class. It's 3 sessions, over 6 hours of information, 3 different sessions. We go over so much information so you'll understand options so much better. That means, How do you figure out what strike price? How do you figure out what expiration? How are these options priced? Then you move into strategy. How do these strategies work? How do they don't work? Then you go into adjusting the positions. Things are going your way. What are your potential moves? Things are not going your way. What are your potential moves? Very comprehensive. And I would be shocked if it didn't help just about everybody out there. Some that are starting out, it'll help you a lot. Some of you guys who think you're running around as being an expert, there'll either be something to remind you of something you might have forgotten or give you a different slant on something that you didn't consider. So that's the Option Master Class. And it has a standalone rate of 397 bucks. We throw this in for free, Okay. Then the alerts. What I do with the alerts is I try to give you some ideas on strangles. I give you some ideas on bull call spreads or debit spreads, up or down, and some credit spreads, up or down. Then I give you a market overview every week on the stock market, on the gold, on the oil, on the international picture, on the interest rates and the dollar, on Bitcoin, okay, on on the overseas markets. Okay, you get my synopsis every week. Now you're getting all this at a discounted price. The regular price is 197 bucks a month, and I'm giving a $100 discount to new subscribers, bringing it down to 97 bucks. So it's month to month. You try this out for a month. If you like it, you continue. If you don't like it, you can hit unsubscribe. And you get to keep the course for free. So at least you walk away with some good education. You have to pony up the 97 to get started. And like I say, if it's working for you, obviously, the information's helpful, then of course you will continue on. If for whatever reason it's not, I wouldn't want you to continue on. So hit unsubscribe button. So again, this is a very limited time offer because of the price being so low. And so I would suggest that if you would like to get, and again, once you hit the complete purchase button that day, you'll get the Options Masterclass sent into your inbox, and you'll get the most recent alerts sent into your inbox, and you'll be in queue for the ones that come out generally every Saturday or Sunday. Okay. And so again, at 97 bucks, I don't really see the big holdup here. So again, rather than beat yourself up thinking about it, if you'd like to give it a go for at least a month, go over to that website. Again, I'll repeat it to you so you have it. It's Option Professor, OPTION, Professor, PROFESSOR.com, and then a / and then Option, OPTION, Alert, ALERTS. That'll bring you to the landing page. You can get started. If you have any questions for me or you would like to ask me anything, it's optionprofessor@gmail.com, and I'll be more than happy to respond to you. Again, we're doing our best to bring you good, solid information each and every week. And again, it is a month-to-month situation. So if it didn't work for you, you can simply hit unsubscribe, and that will be that. But you get to keep that options course. And I think I haven't met many of you that couldn't use a little bit more information on the options, a little bit more insight into how the options work and how to use them, and and all the uses and the risks of options, from the hedging to the buying to the writing, the whole 9 yards. Okay, so anyway, thanks for being here, guys. And again, I hope you guys will all be able to join up and give us a shot here. I think it'd be worthwhile. Until next time, I wish you all the best of luck and good trading. And thanks for listening here today. And we'll be back with you soon. This is Jim, the Option Professor, signing off. Have a great day.